take a look at a question that synthesizes the accounting for accounts payable and notes payable. The following are the selected 2020 transactions of Toys R Us Corp. They purchased inventory from Wholesaler Limited on account for $50,000 on September 1st, and Toys R Us uses a periodic inventory system. They issued a $50,000 12-month 8% note to Wholesaler Limited in payment of Toys R Us's account. So they paid for their inventory with a note payable, and then they borrowed $75,000 from the bank by signing a 12-month non-interest-bearing note. So there's two notes and payment for inventory here. So let's take a look. Prepare the journal entries for the selected transactions above, prepare the adjusting entries, and they've asked us to calculate the net liability to be reported on the December 31st statement of financial position for the two notes. So let's start with the journal entries for the selected transactions. So September 1st, they purchased inventory from Wholesaler Limited on the account, and they use a periodic inventory system. So remembering periodic means they're using different accounts, not just inventory. So they're going to purchase, it's going to be debit purchases and credit accounts payable of $50,000. Right? Yep, $50,000. Okay. Now, next what's going to happen. So on October 1st, they're going to issue a $50,000 12-month 8% note to the wholesaler, so for payment of the inventory. So they're going to clear out, so they're paying their inventory. So we need to clear this out. So we're going to go debit AP. And we're going to need to set up the liability for the note payable because they've issued a note payable for $50,000 for payment of the inventory. And on October 1st, they also borrowed $75,000 from the bank by signing a 12-month zero interest-bearing note. So another transaction on October 1st, they're going to get cash this time of $75,000, and they're going to have another note payable for $75,000. Okay, that's a lot of transactions. Now we need to record the adjusting entries for December 31st. And so thinking about that, that means we need to accrue interest on the two notes payable. So we're going to have December 31st. So we know we're going to have debit interest expense. Let's label this as number 1 note and number 2 note, because I think it will be easier if we can isolate the entries into each of the two notes. So the first note is a interest-bearing note. We know that it is an 8% note, so it's interest-bearing. So we know that the other side of this is going to be interest payable. Even if we don't have to pay the interest, we still have to accrue the amount of the interest. So we're going to do our math here where we're going to say, okay, $50,000, 8%. Okay, so 50,000 times 8% times, so how many months have gone by? So we issued this note October 1st, so October, November, December. So it's been 3 months out of 12. And that is going to give us $1,000 of interest that we have due here. So this is going to be our note number 1. And then we need to figure out what we're going to record for note number 2, which is also December 31st. So we know we're going to have debit interest expense, because we always need the interest to go through the income statement. That doesn't change whether the note is interest-bearing or zero interest-bearing. And let's take a look at this note. So this one was a non-interest-bearing $81,000 note. So we've got $75,000 and $81,000. So 81,000 minus 75,000 is going to give us 6,000 is our interest. So we know it's going to cost us 6,000. It's a 12-month note. Okay, so we're going to say 6,000 times, and there have been 3 months out of 12 here. It is a 12-month note payable. So this number isn't always 12 because we're not dealing with an annual interest rate. The reason that that denominator is 12 is because this is a 12-month note. So that is going to give us 1,500. So this is going to be 1,500. And the other side of it doesn't go to interest payable because it's a 0 interest bearing note. It actually increases the face value of the note. So that's going to be our other side there, 1,500. Okay, so we've got all the adjusting entries done. So then we've done this, and now we need to calculate the net liability to be shown on the statement of financial position for the 2 notes. So note number 1 is going to be shown as note payable, which is going to be the sum of the interest payable and the note payable here. So it's going to be 50,000 plus 1,000, which is going to be 51,000 because those 2 accounts are mapped together in the financial statements. And note number 2 is going to be note payable, and it's going to be 75,000 plus 1,500. So this is going to be 76,500. Again, it's just important to recognize that the interest payable amounts would be included in the financial statements in the note payable amount. Excellent. I think we've mastered notes payable.